Are you in New York?
I am. So I work from home unless I have to go into the city because my commute time is about an hour and a half.
Oh my,
So
phew,
that's 3 hours a day. And
yes.
so when I negotiated to come here, I'm like, can I please work from home? I mean, I'll go into the city if I need to. Not against going to the city. I said, but every day schlepping 3 hours. I said, I really don't want to do that anymore.
No, I don't blame you. Yuck.
So
It takes Lisa and I about 10 minutes to get here from down the road, so
that's
it's
nice. That's
pretty
nice.
easy lift here in Des Moines. Good morning, everybody. Welcome. Welcome to our webinar today with our Chief Investment Strategist, MaryAnn Bartels. This is a great honor to have MaryAnn with us. It's been a couple years, MaryAnn, since we've done this, and I was getting up this morning thinking, what in the world are we going to talk about? There's nothing going on in the world. It's been so calm and sedate lately, huh?
I feel like a punching bag.
I bet. I bet.
But I
Well,
still get up. It's like one of those clown dolls that you keep hitting and it bounces back. But I feel like we kind of have a little bit of a reprieve.
good deal. Well, really looking forward to our conversation today. For those of you that don't know MaryAnn, she's our chief investment strategist at Sanctuary. Many of you are aware that Sanctuary is my corporate RIA back office team that helps with so many areas, and they have done an excellent job building out their investment and research resources for all of us as partner firms, which we're now up to 120. PrairieFire here was one of the first 20 partner firms, so we are the OGs of the group, but have really enjoyed watching them expand. And bringing in MaryAnn was a huge win for all of us. And I get to hear her all the time, but all of you may not get that opportunity. So excited to have her today. You've got a extensive bio here,
Please don't read
MaryAnn.
it all.
I won't. What I would really like is just to hear from you, kind of a quick summary of where you've been. I know all about your technical research and the awards you've won in your many years at Merrill Lynch and Bank of America, but maybe you could just give us a quick hello and where you come from and your background.
Sure. So I've been doing this for now over 40 years, which I never thought I would ever be able to say. I still love it, and every day is different and it's exciting. And, I know the turmoil that we've been in, and we always say it's different this time, but we always recover. And that's what I always want to remind people. We always get a recovery. And we'll get more into that. So my background is a little bit unique. I wanted to be an actress on Broadway. I wanted to sing and dance, have beautiful color hair and nails. And my mom told me I was too smart and had to go to college, had no idea what I wanted to do. And my dad's baby sister, Aunt Bernadette, worked on Wall Street. And I used to go in and have lunch with her. And she used to say to me, MaryAnn, you're a young woman. You should understand how to do your own finances. I don't know where you're going in the world. Well, lo and behold, guess who wound up following in Aunt Bernadette's footsteps? I wound up following. And she went to Wall Street in 1956. She was the first woman on the trading floor of Ladenburg Thalmann on 25 Wall Street. And of course, she started off as a secretary. She became a trader and eventually had her own company with her own newsletter. And I have to say, most of what I understand in markets came from my aunt. She was a technician. She trained me in technical analysis. I also did quant, I did strategy. I'm kind of a blend, but I would say I'm very good at technical analysis after all these years. And she gave me the tools to understand markets and how to look at markets. And I think what's happened today, unfortunately, is too many people have become traders. And it's okay if you're a professional trader. I've traded. I can tell you, you can get it wrong 50% of the time and still make a profit, but most people can't stomach that 50% side that has losses. So, I'm an investor. I look at the longer term trends, and I want other investors to look at the longer term trends too. And what I'm here to do, or at least what I try to do, is to help you navigate through all the noise. My background, I was at Merrill for over 20 years. I worked in strategy. I worked in the quantitative department. I did trading strategies for hedge funds. I ran the technical department for 7 years, and I was a ranked analyst for 6 of those years. And then I went over to the wealth management side of the business, and I was the spokesperson for Merrill Lynch in the CIO office for 7 years. That's kind of a quick overall summary of my Merrill backdrop. I
Well,
retired in 2020, got bored, opened up my own consulting firm, which I think lasted 3 months because Sanctuary found me. and said, "Would you join us?" And I said, "Sure, I'll give it a shot for a year." And after 2.5 years, I'm still here having a ball.
Yeah, that's great. That was a great steal for us, and it's never been the same since. And just as we kick off here, I just wanted to say how much I've enjoyed getting to know you and your work. And one of the things I've been listening to, I've been 25 years in the business, back to Wells Fargo and Morgan Stanley, and have heard so many different market, analysts and people that have their take. And the thing that I valued most about you, MaryAnn, is just I know where you stand. I know what you think. I know what your opinion is and where you think we're going. And many prognosticators won't do that. They hedge, just like we do in the markets. We try to hedge a little bit, but we always know where you stand, and I so appreciate that analysis. So to kick us off, it's been a crazy week and a half back to Liberation Day. Maybe just give us a feel for where you feel the current states of the markets are, what your reaction was to all of that noise over the last week. Yeah, just kind of a view of the landscape right now.
Sure. Just so you know, the reason why I have a conviction is Aunt Bernadette told me I had to have one. Uh,
Well,
She says you
she's
have
this.
to help investors and she says you have to help them make money and you need an opinion.
Yeah,
So
well,
I credit Aunt B with that.
all right.
The first thing I had to decide when the tariff fiasco happened is, are we just in a correction in a longer term uptrend, which we call a secular bull market, or are we entering a secular bear market like 2000, like 2008 and 2009? Because the market behavior is very different. If you're just in a regular correction, you can go down 20 or 30%, but you'll recover and you'll go on to record all-time highs again. When you're in a, or if you're about to enter a secular bear market, markets go down 45 to 50% and you don't see new highs for over a decade.
Mm,
So that was the most important decision for me to make. And I still believe we're in a secular bull market because the leadership of the market, I don't think has been broken. And that's technology. And we can talk about that. So what gave me confidence in addition to looking at the long-term trends, because I don't know Mr. Trump or President Trump very well, and I don't have a hotline number to him. So I did not understand what his threshold for pain was, meaning how much of the economy is he willing to break? How much of the markets is he willing to break? Because obviously he's willing to break something or to disrupt, probably a better word, disrupt something. For how long and how deep? And we got our answer. We got our answer when he extended or delayed the tariff for 90 days. And why did that happen? Okay, we had a very sharp decline in the equity markets, one of the fastest declines we've ever had. I'd call it a mini crash. Nobody's calling it a mini crash, but it felt like a mini crash. And there were many that were speculating on Monday, following Thursday and Friday, after the whole April 9th thing, that we would have another crash. And what I found fascinating is the support zone, and this is where technicals come in. There's very key levels that we watch. One of the key support zones was around the 4,800 level on the S&P. And sure enough, around 4835, a tweet came through that this is, I think, on a Monday, that the tariffs were going to get delayed. But it wasn't from the president. We have not verified, nobody has verified where that tweet came from. I suspect that got leaked on purpose to help stabilize the equity market. I have no proof of that, but after all my years in the business, I suspect somewhere in the administration, they understand markets, they understand levels, and they wanted to stem a severe decline in the markets.
mm,
That was again confirmed because when the bond market was having liquidity issues and we were having, nothing was blowing up, but there was liquidity issues. And I thought Rink Santelli, who's the bond guy on CNBC, and he was a bond trader before he became a commentator, he had a great way of explaining liquidity in the bond market. He said, in the treasury market, you should be able to move paper, basically trade, within 30 seconds with no problem. But when that 30 seconds gets wider and wider and wider, you have a liquidity problem. And that started to happen in the fixed income markets. And sure enough, we had word out from the administration that they were actually going to delay now the tariffs. And that's what stabilized everything. What
mm,
that tells me is that the Trump administration does not want to break the capital markets, and that's extremely important. So I feel that there is, some people call it a Trump put. I do think there is a Trump put. There's so much pain they're willing to take, and then they're not willing to take anymore. So I think we've made a low. And from a technical perspective, we got confirmation of that. What we look for on a low is basically everybody selling and volume spikes. It's a huge spike in volume. And we did get that. We look for the internals of the market to be really bad. So when we look at how many stocks are trading below their 200-day moving average, you want that around below 20%, and we got that. When I did the difference between new highs, new lows, if basically one of the worst readings in the history. So we got what we call capitulation, that panic selling, and that creates a bottom in the markets. But normally we have to chop around and eventually test that low. We didn't have to do it during COVID because both the government and the Federal Reserve provided a lot of liquidity during COVID. So we didn't have to do that. But on most big climactic lows, we have to test them. Now, here's the interesting part. It can be anywhere between a month to 4 months before you test that level. And testing is kind of tricky in the sense that when you say test, some people think you have to go down to that level, like 48.35. Well, you don't have to go down. You can test at a higher level, or worst case scenario, you make a new low. And it doesn't feel good, but how do we know it's a good level? Is that we watch that volume doesn't go up as much. You don't make a new peak in volume. The VIX index, which you'll hear a lot about, especially on television, that measures volatility, doesn't go up as high as it did. In this case, we went to an extreme over 60. But on the next decline, it doesn't spike as much. And those new lows, you don't make as many new lows. So it's a process in building or repairing that initial decline that allows you to continue to rally over time. So I always tell clients they need patience. Markets, it's a lot of fun when markets are going up and you're making money, but when we're in a corrective phase, that's where clients have to have patience.
Yeah, that's a message that we send, but when it's happening, it's certainly frightening for everybody. And when you see this kind of velocity, and I'm thinking back like the Greek debt crisis, because '08 and '02 felt kind of like a dirgy down. It just kept going down because
Well,
there was just
that was, 1,000 cuts. That was awful.
right, right. This was a little
Um,
bit different in the drama and the
This was like an initial reaction. That's why I call it like a mini crash. It was like a mini crash or like a flash crash that happened in 2 days. One of the
hmm
fastest declines in history.
hmm
But, in some ways, I like that. Just get the pain over with. In 1987, which was my first bear market. So I'm only a couple of years old on Wall Street. And I remember that Thursday and Friday with the markets going down. Every market cycle, you're looking at different data. Back in that cycle, we were looking at the deficits. And we got a bad deficit number on a Thursday, and that's what really created the markets. And then continued on a Friday because no trader wants to go long. And then over the weekend, we had a Treasury Secretary that didn't defend the US dollar, and all hell broke loose on Monday. Now, on Monday, what happened is back in that day, we thought defending a portfolio was using portfolio insurance. So it was very common for big institutions to have portfolio insurance where if the market was down a certain percentage, they would sell. And what happened is this became a cycle on
hmm
Monday where everybody just became a seller. We didn't have circuit breakers. So we wound up having a crash where we were down 20% in one day. The good part of that was we were all in the same boat, no time to react. And then the healing process happened. And by the end of the year, we actually did not close down. We actually closed at a slight positive. But what was different, what I remember about that, because we just had computers, we were just starting to model Wall Street. I remember people saying that we needed to remove the emotion and model. And let me tell you, that doesn't help either. What helps is having a diversified portfolio and having patience and owning quality assets. And
Yep.
that has worked through history for hundreds of years,
hmm
basically. If you have a diversified portfolio, you own good quality and you have patience and you don't panic, your portfolio grows over time. And then the other part is if you have dividends and you reinvest those dividends, it compounds over time. And so I'm a true believer in the capital markets. The capital markets aren't broken. I'm not panicking here. The big theme, if you want to talk about it, what I think will drive markets over the coming years is that we need to adapt new technology, which is artificial intelligence, known as AI, and blockchain. Blockchain is a technology. Bitcoin is a little bit, and crypto is a little bit different. But we're going to adapt that technology. And I do believe the best companies in the world to do that are housed here in the United States. They're not in Europe. I don't think we're using Chinese technology. They're not in Japan. We are the main source of the innovation of technology.
Yep, I agree. So if we look at what I'll call a new tariff regime that we're under, it's very uncertain still as to what's going to happen over the next 60 and 90 days. What do you think? How do you think the market's going to behave based on tariffs now going forward?
So this new 90-day delay is helpful. There was a tweet yesterday where we need to help companies. That's what I mean. It's like I kind of feel what I felt like yesterday. As I said, we're going to get so beat up with different tariffs, what's on, what's off, what's, modified, because it's hard to keep up with everything. That by the time we get the final tariff implementation, we're going to be go, oh, it's done. We're going to be so relieved. And what I'm hearing some commentators on the political side say, what most people are factoring in is that we'll have a 10% tariff across the board.
Hmm.
That ultimately the tariff regime will change. There's commentary out this morning that we're talking with the EU with having no reciprocal tariff on certain things. Again, it's this constant pounding that by the time we get all of this done and settled, we'll go, but what I think I took away from what was happening and how it kept getting changed is that this is more of an attack on China than anything else. Yes, Trump wants to raise tariffs to raise revenue and maybe e- equal out the playing field, but it's a clear war with China.
Yep. You mentioned this briefly with the reference to Rick Santelli and the bond market. And generally, what I've seen when we have market corrections is there's a bit of a flood into the bond market. People want out of stocks. They want the safety of the treasury market. They want their what it used to be 2%. Now it's 4.5% guaranteed in that market. When this was going on, rates were actually going up. So it was like bonds were getting sold in that environment. What do you think that happened? What did you see going on there? Are we in for, I think it was James Carville that worked for Bill Clinton that said, when I come back in my second life, I want to be the bond market because it's the most powerful thing in the world.
The
What do
bond
you,
market, yeah, you're right. The bond market is one of the most powerful markets in the world, and it's one of the largest and the deepest in the world. And what happened with the bond market was highly unusual. It's not what you would expect. And the same thing for the dollar. The dollar normally goes up in a crisis and it went down. Now, there's speculation out there and only speculation. China was selling treasuries. There's speculation that Japan was selling treasuries. Now, the largest holder of treasuries is Japan, and China is one of the largest holders. We can't run on speculation. There's also commentary that sovereign wealth funds were sellers of US assets. I think what's safe to say, because we will get data, we'll get data of where the selling took place, but we won't have it till June because the Treasury does release that. What I think is safe to say is that there was a global asset allocation change where global investors were most likely very overweight US assets. And with what was happening with tariffs, they felt that they had too much risk and wanted to dial down their US exposure. I think that's very fair to say. And we just got what's called the Global Fund Manager Survey out of a Bank of America. It's one of the most widely read reports in the world, where they go out and survey professional fund managers around the world on their thinking and what they're planning on doing. And it had one of the most bearish readings in its 25-year history. It was the fifth worst reading in 25 years. And the highest reading of asset managers saying that they wanted to sell US equities. Now, we use that as a contrarian, meaning when everybody's in the same pool, the likelihood of more people being able to fit in, so you want to get out of the pool. So in this case, since everybody wants to get out of the pool of the US, it's time to jump in the pool. You want to do the opposite of what everybody's doing. So to me, that survey was extremely bullish for US assets.
Hmm.
So I think you can have short-term damage politically where, what happened is really not fair and unexpected, and politicians and investors want to dial back. I get that because I'd probably be one of those people myself temporarily. But at the end of the day, if you want to live in this new digital world, you have to buy US technology. Now, Germany came out and said that it was willing to invest 1 trillion euro, part of that in defense and part of that in infrastructure. So that's very bullish for Europe. And I think Europe is changing in terms of its own investment. But where are they going to get this technology? They don't have it. They have to come here.
Mhm.
In defense, who has the best military in the world and equipment? It's the United States. So I don't give up on the United States. I mean, yeah, we might have some bruises right now, but I think at the end of the day, once we have clarity, and we will get clarity within time and reassess, our capital markets will continue to work and our companies will continue to work, and that will drive asset prices higher. Now, as for the bond market, we did see this spike up, but we've come back down again. So I do think that that was a think of what happened in the bond market very similar to what happened in the 2 days that our equity market went down. So they hit the stock market first, they hit the bond market second, and now we're going to kind of be more in a level playing field. And I'm in the camp that rates in the near term will continue to go down. We are going to get a slowing, and this is going to slow down the economy. I'm not in the camp that we're going into a recession, but we are going to slow down. And in that case, I do think you're going to see interest rates decline over time.
Okay. Yeah, I think there's been a lot of. I remember it was in 22, early in the year. Everyone except you was saying we were going to a recession for sure. Never happened. Markets did well. Maybe that was 23, excuse me. Then 24, we had another good year, and everybody was kind of throwing up their hands, giving up to the bull in a way. And so now there's been, when there is all this trepidation, and we're definitely heading into a recession. It's absolutely, this is going to be what I always coach my clients on is that we never know we're in recessions usually till they're over, and the market's going to recover long before that recession is over. And
This is
so
true.
maybe you could talk about that a little bit, and maybe if your technical support kind of where we're at when it comes to that recession story.
Sure. So I was comforted because the banks have been reporting, they've been reporting blowout numbers. Now,
Yeah.
that's the first quarter, that's prior to the tariffs. But Brian Moynihan, who is the CEO of Bank of America, one of the largest banks in the world, was out saying today that they don't see a decline in the consumer yet. Not yet. Delinquencies are actually getting better. In other words, we're not getting more and more delinquencies. So he right now he doesn't see a recession, and he doesn't think we have a recession until unemployment goes up and the consumer doesn't have a job. And I would agree with that. You're going to have to see a lot more people get unemployed before we lose the US consumer. Now, is the low-end consumer struggling? They are. I even see it in my own world with people around me, like my housekeeper and some friends. They're complaining about the cost of food, that it's, costing them more. So I get there's part of the economy struggling, but they do what's called substitution. So you go from the higher price brand to the no-name brand, or you just eliminate certain things. But we are seeing a consumer out. And I don't know about where you are, but every time I go out to dinner, the place is packed, no matter
Hmm.
where I go. People are still eating out. So that's a good that's a good sign. Now, if we were to go into a recession, the market will get there before we even know we're in a recession. The S&P 500 is a discounting mechanism, and it will price in a recession. I think it's priced in a slowdown. I think it's priced in a slowdown in earnings. But if we are going into a recession, we need to price for a recession. And the bad news is I think the S&P then has to go to 4,400.
Mm.
That's going to be below the 4835. And that's so in recessions, you go down 30% or a little bit more than 30%. So the market is not going there, at least right now. I don't see it going there. But if you're in the camp that you want to position a portfolio for a recession, you would have to look for more downside within the marketplace.
Okay. If you're going to sort through life post tariff, let's say 10% is the number, and that's the new normal going through the rest of 25 here. I know you love big tech. I'd love to hear you talk about that and give your opinions there. But other sectors that we've been preaching infrastructure here at PrairieFire that we think that's a decade-long change in the overall global economy and rebuilding and the power grids that go with AI, all of that is as part of an investment theme, but would love to hear what your thoughts are there.
So we like infrastructure too, and this ties into building out part of the data centers, right, for AI. What I found fascinating is you can pull up electricity prices. And if you look at electricity prices, for 20 years, they went nowhere. They were flat. Maybe your bill wasn't flat, but in general, electricity prices were
By no
flat.
means. Not with my kids come home anyway. Yeah.
But now we're getting an increase. We're seeing demand for electricity to go up. And of course, it's being projected to go up. Our infrastructure is old. And not only do we need it for AI, we also need it for blockchain. And we don't talk about blockchain, but the miners, we need electricity. So, I like utilities for that. The best tech companies are here in the United States, and they have this is the difference between 2000. They're mature companies. They have great balance sheets. They're sitting on billions and billions and billions of cash. Now, are they investing that cash? They are. The other positive is that we're seeing, like we saw today, NVIDIA willing to commit $500 billion to building its chips here in the United States. Last week, we had the CEO of Amazon out saying that they're still committed to spending on AWS, which is their cloud. We've had Alphabet or Google out saying that they would spend 20 billion. Everybody was so focused on Microsoft pulling back its spending, they lost sight that there's still investment going on in technology, and it is a long-term theme. Companies don't invest over the next 6 to 12 months. They invest over the next 3 to 5 years.
Mhm.
And if it's okay, if I can give an analogy, because I think this helps investors. If we go back to 1500, which I will honestly tell you I don't remember, but I did look it up. In the 1500s, we were an agricultural economy, and the technology we used during that time was a sundial, right? Because we were farmers. We really needed to understand the sun and the sun patterns. Our economy did not shift out of agriculture as the main driver of the economy until we built the combustion engine, right? And once we built the combustion engine in the 1700s, we started shifting to a more industrial-based economy. But from 1500 to 1700, we were agriculture. I always say 2000, but it's really the 1990s, we went digital. This is when technology really started to take hold in not only computers and the internet. And if you take 1700 to 2000, that's 300 years. So when we make a major macro shift in our economy, it's around for hundreds of years. We are going digital, whether you want to be on that train or not. I understand the older you are, the harder it is. I didn't grow up with technology. My technology was a TV and a phone. And I remember when we got the long cord, I was so excited. So I could hide on the stairway so my parents couldn't hear my conversations. I mean,
And then wireless. Oh my God.
wireless, wow. But I tell people, watch Star Trek because we're really following Star Trek technology. We started with a flip phone, right? Kirk had that little flip thing. That's our flip phone. You go to Star Trek The Next Generation, their consoles are iPads.
Hmm.
If you really look at them, those are iPads. Aurora or whoever was in communication had an earpiece in talking. Everybody's walking around now with an earpiece in, right? Hologram. We already have deep fake videos of people that look real. Or you can go to a museum and there is a hologram of a person talking to you. Got that?
Yep.
Now, what's the currency on Star Trek? You have to have a really hardcore fan to know this one. I had to look this one up.
Yeah.
Okay, there's
I'm
two.
not that fan. I'm more of a Star Wars guy, but
Okay. And Star Wars is great and probably in many ways a little bit more advanced, but we're following the technology that in Star Trek. They had what was called latinum, but latinum was not stable and had to be put in gold. And gold has been used as a currency for millennia. So think of gold, latinum as a form of payment currency. But they also had Federation credits. All right, now I want you, now this is where I'm going to link it to digital.
okay.
There's the blockchain. The blockchain is a ledger of debits and credits, right? And it gets verified, but it's really a ledger. You heard the credit part's credits. Well,
Hmm.
you can find episodes where they're paying with Federation credits. Bitcoin trades on the blockchain, and I believe is our first digital credit. Bitcoin is a currency. Everything else is a form of technology. Ethereum, Solana, XRP, they're not currencies. They're technologies. But Bitcoin is the currency. Now, some people say, but MaryAnn, we have PayPal, we have Zelle, we have Venmo. I said, that's technology to move payment. It's not dollars. It's not a currency. Bitcoin is that currency that you can move on the internet. So it's the internet. Think of it, the cash of the internet is Bitcoin. I'm not recommending it, but I do think that is symbolic of how we're going digitally.
Hmm. It's a brave new world. I mean, we're heading in places that only in Star Trek could we have imagined.
Exactly. And that's why I tell people to watch Star Trek because we are Star Trek now.
Hmm.
Or think of, oh, the cartoon. Oh, now
Jetsons.
The Jetsons.
Yeah, I was watching The West Wing, and the guy said to this guy from NASA, "Where's my jetpack, man?" I was watching the Jetsons when I was in the
Yeah.
'60s, and I'm waiting for my jetpack.
Yeah. So and it's hard if you don't grow up in technology, it's really hard. Like the kids today don't carry money on them. And us of the older generation are like, can you just put 20 bucks in your pocket, right? Because we're used to having that form of currency. They're like, and my mom, I'll do that with my kids. They're like, Mom, fine.
Yeah, I'm still old school, still always carrying a little cash around. You just never know.
Right. But the younger generation doesn't do that,
Hmm.
right? They're fine operating digitally because since they've grown up, their whole world has been digital. Our
Yep.
world was not digital. And that's why the older the investor, the harder it is to understand this new technology. And I get it. I have to brave out into this new world. I did something for the first time. I'm so proud of myself. I went up on X, formerly Twitter, and did a I was a guest speaker on a podcast for a portfolio manager that used to be at Fidelity, who now has his podcast, and he's out on what's called Spaces, which is part of X. I didn't even know what Spaces was.
Mhm.
And so once he taught it to me, I now go up. There are more podcasts up on Spaces that are live. Some of them are recorded, and there's thousands of people listening.
Hmm.
Thousands. I was just it's mind bending to me. So it's not just like YouTube, right? There's a lot going on YouTube, but there's a lot going on X. And we all know about TikTok. That's totally different. People are running businesses on TikTok.
Yep.
I didn't think I could be an influencer and become a millionaire, but you can today.
Oh yeah.
So
Yep.
the world has changed. We need to, right? Darwin, wasn't it Darwin? It's not how healthy the animal was in terms of survival, is that you had to adapt to change.
Hmm.
That was the key to survival.
Definitely feels like as an investor these days, it's some of the themes remain, which is patience that you've mentioned, diversification, all of that. But every crisis feels a little bit different, feels a little more harsh. Should I be doing something different this time? But
Exactly.
a lot of those themes play out, but definitely some new investment themes or just some new things economically and society as a society that we have to consider and be thinking about. So,
Even Warren Buffett says, when things go on sale, we're all running into the store. But when the market goes on sale, we're the first ones to run out.
Yep. Yep. And off they go. So I'd encourage anybody that has any questions to put it in the Q&A if you have any. I'm going to have MaryAnn wrap up her comments. She's been so gracious with her time already. But as we move into the rest of the year, a lot of people, including you, have brought your forecast down for the S&P a little bit. Maybe just talk about kind of where you think we go from here. Any advice you'd give to our clients is kind of, your parting comments.
So there was technical damage done to the market on the recent decline. That was not something I was looking for. I was looking for new highs this year, quite substantially higher, but that has to go on the back burner. We'll eventually get to new highs. If we follow the traditional pattern of testing a low, it can take a month to 4 months to test. So you stay in this choppy trading range and then you start rallying. So I think this year, the best case scenario, without any major changes happening, because anything can happen in this world now, we close kind of flat to slightly down. Now, if we're going into a recession, we'll close way down. So what do I mean? Well, flat to down maybe 5%, no recession. Recession, we close down 10%. But this is where I think you get great buying opportunities for good quality companies. But I introduced a 12-month forecast. So I think in a year from now, we're going to be at new highs. And I think we'll get back up near 65.50. And eventually we'll get up to my original targets of 7,000, 7,200, 7,400. I do believe in the secular trend that our long-term target is still intact of 10,000 to 13,000. I think that's where the train is moving.
Mm.
Then I'm concerned that we enter a secular bear market. But I don't see any signs that we're in a secular bear market, because in a secular bear market, you just have to become more defensive.
Yep. Well, it'll be interesting. There's always something. I always tell clients, well, I don't know what's around the corner, but there's something, and we just have to prepare for a range of outcomes. And as I saw, portfolios hold up pretty well during this recent downturn. It did have a little bit of a reminiscence of COVID, just with the sharpness of the move, and then we got some moves back up. But it's good to hear your reassurance that that path is still something that we can sustain. That although damage has been done, we've got a decent path going forward, albeit there's some sort of policy nonsense or whatever that derails us. But overall, things still look pretty good, is what I'm hearing you say.
Yes, the capital markets are still intact, and I believe companies will be able to navigate through this in the end. At the end of the day, what makes stocks go up? It's corporate profits. And I think artificial intelligence will be part of the answers of growing corporate profits going forward.
Great. Well, MaryAnn, thank you so much for being here. I so appreciate you taking the time, and it's been, like I said, so fun to get to know you, and looking forward to seeing you September at Oasis when she always presents. And I tell you what, these are presentations, people. She comes out. What was it? What was it last year? Was that the gold?
At the golden age of investing, and I still
Yes.
believe this is the golden age of investing. And we had gold sparklers flying up in the air,
Fireworks.
fireworks going.
Yes.
Yep.
I like.
I wouldn't look, yeah, don't lose sight that there's still a golden opportunity to invest.
All right. Well, we're meeting in Scottsdale, so I don't know if you'll have kind of a Southwestern theme. Maybe it'll just be your own thing. I'm sure it'll be amazing for all of us to witness, though. So thank you so much again for being here, MaryAnn, and for all of you that joined us today. If you do have questions as a follow-up, just shoot me a note. Appreciate you being here with us. And MaryAnn, I look forward to seeing you real soon.
Thank you. It's been a real
All right.
pleasure. Thank you for
Thanks,
having me.
everybody. You bet. Bye-bye.
Bye-bye.